Exercise 13B4, Basic Net Present Value Analysis including income taxes. By the way, this will be the last question I do in this book. After this question is done, break out the champagne. We're done. Now I'm going to go through this one rather slow because I'm going to argue that we're going to do it a slightly different way, so that you can see what happens when we have an addition to the pool midway through a project. This is important to know, so follow along here. Norris Property Management has been offered a 6-year contract to provide grounds maintenance for various condominium corporations. To accept the contract, the company would have to purchase several pieces of equipment for both summer and winter grounds maintenance at a total cost of $280,000. Other data relating to the contract follow. Net annual cash receipts for the contract, $81,000 per year. This is before tax. Cost of overhauling and rebuilding the mechanical equipment in 4 years. Now, let me read that again. The cost of overhauling and rebuilding the mechanical equipment in 4 years, $33,000. And finally, salvage value of the equipment at the termination of the contract, $15,000. If the contract is accepted, several old, fully depreciated pieces of equipment will be sold at a total price of $22,500. Read that sentence carefully. Several old, fully depreciated pieces of equipment will be sold at a total price of $22,500. The key word here is they're fully depreciated. Okay, we're going to deal with that. These funds will be used to help purchase the new equipment for tax purposes. For the new equipment, period. For tax purposes, the company computes CCA deductions using the maximum rate of 20%. Company requires an 11% after-tax return on all equipment purchases. The tax rate is 30%. So let's first of all model this on our timeline. What are we doing? We are spending $280,000. Over how long? A 6-year period. What's our salvage value at the end of that period? $15,000. Beautiful, we've got that, right? We're going to sell some equipment today for $22,500. This equipment will require, in year 4, a major overhaul with a cash outflow of $33,000 and will provide an annual before-tax income, net income, after all expenses, of $81,000 over that 6-year period. So we've modeled it. We have the bottom of our timeline, we have a t equals 0, and we have the top of our timeline. So we have 1, 2, 3 elements to deal with here. We are also told that our CCA is 30%. We're told that our tax rate is another 30%, and that our weighted average cost of capital is 11%. Now, here, there are 2 big issues here, and it really depends on how you read the question. One of them is fairly straightforward, one of them isn't. So let's take the expenses we have at t0, not the expenses, but the cash flows we have at time t equals 0. We're buying a piece of equipment for $280,000. There's no interpretation on that. It's $280,000 that new piece of equipment we're paying for. So that will go in to the asset pool at a price of $280,000. But additions to the asset pool are made on a net basis, which means that if we have a piece of equipment in the asset pool that we remove and sell and replace it with another one, it's not the $280,000 that would go in, it's the net difference that would go in. So one might argue that, well, the CCA pool will increase by $257,500 because this is coming out. That would be right, except if we were selling this asset for $22,500 and its undepreciated capital cost were $22,500, the net addition would be $257,500. But the book says, the question says very clearly that these assets that we're selling are fully depreciated. They're fully depreciated. So that means For the CCA purposes, we're going to use 280. We don't net them out because this is fully depreciated. We're going to use 280. Now, if you read the question and you didn't quite see the complexity of that, then you're not understanding what's going on here. We're going to use the full 280 because this is fully depreciated. All right, so what we want to do is, remember now, for step 1, we're going to walk through this nice and slow. Step number 1 is we want to convert this into an after-tax cost, an after-tax cash flow. So we're going to use 280 for the CCA, but as far as cash flow is concerned, we have 22.5 coming in, 280 going out. We could argue that we have 257.5 coming in. I don't want to argue that. I'm going to say we still have 280 going out. Okay? The 22.5 that we're getting, let's think about this for a minute. We don't have to make any adjustments to the CCA for this. To the asset pool, we don't have to make any adjustments to it. Here's the problem, though. We're selling these assets for 22.5. They've been fully depreciated. Do you see the issue? Does anybody see the problem? When we sell them for 22.5, what are we doing? We have a recapture of depreciation. They were depreciated down to 0. So when we sell them for 22.5, we got a gain on the disposal of asset. Imagine that you bought an asset for $10,000, you depreciated it down to 5. You're carrying it on the books at 5, you sell it for 6. Well, think about the journal entries you need to record that. You remove the asset of $5,000, you remove the $10,000 from the pool, the $5,000 from the depreciation. What do you do with the other $1,000? You call that a recapture of depreciation or a gain on disposal of asset. Well, this 22.5 has to be dealt with somehow. Now, I'm pretty sure I'm going way further than the author of the question wanted us to go. But now that we've opened that can of worms called tax, this 22.5, that can't escape unscathed. That's got to go by the tax man. The tax man's going to look at that and say, hang on a second now. We allowed you to depreciate it to 0, and now you're getting some value for it. You got to make us whole. So while I'm willing to let the 280 go into the asset pool as 280 and calculate the tax shield on 280 because this was depreciated to 0, I am unwilling to let the 22.5 go by without giving the tax man his pound of flesh. If the tax rate is 30%, and I either call this a recapture of depreciation or a gain on disposal of asset, I got to pay tax on that 30%. There's just no way to go about it. So that my cash inflow at time t equals 0 will be 22.5 times 0.7, which is 15,750. Now, that brings up another problem. If I sell it today, I don't necessarily have to pay tax on it today. That tax that's due on it, the tax that I would have to pay, the 30% on that, is due in 1 year. However, for simplicity purposes, I'm just going to net it out now, and I'm going to say that there is $15,750 on an after-tax basis coming in. So I want to be clear what I've done here. This number, this 13B4, this question we're on, has a lot in it. You can answer it naively and just say, well, the 22.5, I'll just take off the 280 and we're spending 257.5. And you may start to calculate depreciation on the 257.5. From an accounting perspective, that's very wrong. This is being depreciated to 0. Let me repeat it again. It's being depreciated to 0, these assets, which means the net addition to the asset pool is 280. The value of your tax shield will be on the 280. But you're getting 22.5 for something you've depreciated to 0. The tax man's going to say, whoa, that's not tax-free income, my friends. You owe me some money. Your tax rate is 30%. Pay me now. So that you don't really get 22.5 to offset on the 280 on a cash flow basis. you get 15,750. You have to turn that into an after-tax basis as well. I bet you didn't see that when you first read the question. You said, oh, this is really easy. Not so much. All right, so let's take care of that. Okay, there's our 6 years. And our salvage value, we know we don't have to deal with our salvage value. That's in the tax shield. We'll deal with that. On an after-tax basis, it is what it is. Simple as that. Now, we could argue that it may be depreciated to zero, but that would be an accounting depreciation. For CCA, it's not going to be depreciated to zero, so we don't have to worry about it. Let's take this $81,000. We get $81,000 in cash flow, but we have a 30% tax rate. So to turn our cash flow into an after-tax cash flow, we take 70% of that total. We get $56,700. So for 6 years, we get $56,700. Now, what do we do with this $33,000? The first argument you could make is that, well, it's maintenance. It's maintenance, and let's just discount it back to this period of time. Well, that's a simple argument to make. Let's say that it's year 4, you're a publicly traded company, you're spending this $33,000. Now think about it from an accounting point of view. If this is a private company, let's start there. If this is a private company, your motivation is to pay as little tax as possible every year, and you don't care what net income you're showing, because it's a private company, it's your own company. So you would say, hey, this $33,000, I'm going to take it all in year 4. I'm going to charge it all in year 4 to lower my income, because if it's a private company, you want to show zero income every year. You never want to pay tax. So you'll take it all. You'll push the bounds of it and you'll say, I'll take it all. Revenue Canada might come along and say, why'd you take it all? And you would argue, well, because it's maintenance cost. It's all maintenance. And you would really push that. It's maintenance. So you'd take it all. In which case, we would adjust this $33,000 for our tax rate of 30%, and then we would discount that back to get our net present value of that. Now flip it around. You're a publicly traded company. You're a growth stock. You're growing. You have a good increasing share price, and you know that the value of your company is more important than the amount of tax that you pay. You want to show high earnings per share. So you do not want to charge this $33,000 in income to income that year. You want to capitalize this $33,000. You want to capitalize as much as you can. You want those huge earnings per share. You want that huge growth rate in net income. So the argument you can make here, which is what we're going to do, is we're going to say this is an addition. During the life of this project, not only do we have an initial addition to our asset pool, but we have an addition in year 4. We're going to take this $33,000 and add it to the original cost of the machine by arguing that this is a significant upgrade to the machine and not just maintenance. So we're going to say that this is an addition to the pool. So because it's an addition to the pool, there is no adjusted cost for it, but there is a separate CCA tax shield for it. You're probably thinking this is getting too complicated. No, it's not. Here's what we've done. We've adjusted the cash flows we wanted to adjust. We've adjusted the sale of disposal on asset, which we should have adjusted because it was depreciated to zero. We are not adjusting the addition to the CCA pool. We're going to take a tax shield on the 280 minus the 15, and we're going to take another tax shield on the 33. And you're probably wondering, well, how do you do that midway? Let me show you. Let's start, all right? So now that we have our cash flows, we'll worry about our CCA in a minute. Let's model these cash flows right here. These 10 cash flows of 56.7 and the 15, and we'll pair it off against our 2 outflows down here. So our N equals 6. Our future value equals 15,000. Our Y on our calculator, weighted average cost of capital, is 11. And our payments are 56,700. 56,700. I forgot a 0 on the end there. 56,700. So all we have to do is find the present value of this, and we get 247 247,891. So we've taken care of all of this. So now we have this stuff to take care of here. So let's take care of this 33. That's easy enough to take care of, right? We're going to spend 33, but remember now, this is not a tax deductible expense because we're capitalizing it. We're calling this an asset when we do it. So we would simply take negative 33,000 and we just want to discount it back at our weighted average cost of capital for 4 years. We just want to bring it back here. And that will give us negative 21,738. Beautiful. So we've taken care of this. Now we only have to take care of this. And all we have to do is just net them out. So let's see what we have. We can figure out this before we even look at our tax shields. What we have is, we have the 280 minus 15,750. So if you take 280,000, I haven't done it yet, minus 15,750, we will get 264,250. 264,250. There's our initial cash outflow for our initial investment. That's the cash outflow for our initial investment. The 280 we're paying, and only 15,750 of the 22,5 because we're rightly assuming, not assuming, but rightly saying, there's going to be a tax implication of that, so let's deal with that now. Now we have the cash outflow in year 4, which is 33, which in today's dollars will be 21,738. That's our addition to the pool, and we have our 247,891, which is our cash in. So if we take all of these and add them together, we get, let me just do it quickly for you, minus 247,891 equals, we have a negative 38,097. So we're net present value negative, but we have 2 tax shields. So let's deal with the first one because we've seen the first one before. We know how to deal with the first one, right? So let's deal with the first tax shield that we have. And you remember it's CDT over D plus K times 1 plus 0.5 K over 1 plus K minus the salvage value over D plus K discounted back 1 plus K to the negative N. Look how easy that is when you know what you're doing, right? Now remember, we're using the full 280 because the net addition was 280. These assets we sold were fully depreciated to 0. So when we sold these, we didn't have to make any adjustment to pull it out because it was already 0. So the net addition is 280. So we figure it's 280 times 3. We have 0.3 on CCA, 0.3 on tax. Our CCA and our WACC add up to 0.41 times we have 1.055, which is half of 11% divided by 1.11. Multiplied by, minus the second term, which is 15,000, 0.3 over 0.41 times 1.11 to the negative 6 because we're getting the salvage value in 6 years. That will give us 58,417.93 minus 1760.40 or 56,657.53. I know the question says round to the nearest dollar, but just work with me. So there we go. This negative 38, we've modeled all of just the cash, just the after-tax cash flows. This 56,000 is the tax shield associated with the 280, assuming a salvage value of 15. This 33, we have to calculate the tax shield associated with the 33. How do you think we're going to do that? Well, we know that the first term, look up here, what I'm doing in white, this first term applies. That is the tax shield associated with any addition to your pool, adjusted for the half-year rule. So we don't have to do anything more than look at this. What's our salvage value? Well, this is a major upgrade to this piece of equipment. This piece of equipment will be sold for $15,000, which means the major upgrade will have a salvage value of 0. The $15,000 is the salvage value of the 280 plus the 33, but we've already fully modeled the $15,000 over here. So even if you argue, well, of this $15,000, 10 belongs here and 5 belongs here, it would still, those two amounts would still add up to the same 1760.40. So all we had to do is model it once, and we have. We've accounted for the salvage here. We've modeled it once. We're going to assume this has 0 salvage value. Now, your argument might be, but it's only 2 years. It's only 2 years. That doesn't make any sense. You've got to read the chapter carefully, and you've got to read the appendix carefully. Let me see if I can find the page where it explains what you do in addition to the pool. And here we are on page 638. I want you to look down on the lower 1/3 of the page, the bottom third. There's a paragraph that starts, because. Now listen. Because the CCA is calculated on the declining UCC balance of a pool of assets rather than on a single asset, this is important now, a business is able to obtain tax savings from a project even after its disposition, as long as there are other assets in the pool and the proceeds from the disposal are less than the UCC for the class. Tax savings can be realized in perpetuity. In perpetuity. So, yes, in year 4, we're going to add $33,000 to our pool. And we're going to assume that by year 6, it's gone. But this $33,000 can continue to provide benefits long after the year 6, as long as the $15,000 that leaves the pool, when this $15,000 leaves the pool, that the UCC, the undepreciated capital cost of the asset pool, is more than that, this continues to provide it. So all we need is the net present value of this. Do you see one more issue that we have to do? So let's just show what that looks like right now. That'll be 33,000 times 0.3 over 0.41, it's just the same as this, times 1.055, yes, the half-year rule adjustment applies to this as well, 0.11, equals 688497, 688497. Do you see a problem with that? Anybody? You should see a problem with that. This 688497 is as of this date. That's the present value of the tax shield of this 33,000 brought back to this date. We need to bring it back to this date. So once we get the answer, we need to divide it by 1.11 to the power of 4. In other words, we need to get the present value of this thing. So if we take 6884.97 and divide it by 1.11 y to the x4, we get 453,532. A lot more complicated than you thought originally, right? But here's the thing. If you understand what you're doing, you would have seen that. If you have an understanding of this, you would see this. If you're just trying to remember all the steps and memorize your way through this, you would never have seen this. Which means if this is the route that your professor wants you to take, you would never have seen that. You would have looked at that and said, well, I'm just going to net these two out, take the after-tax of this. Step 1, I'm going to do this. Okay, what do I do next? The CCA. Okay, I'm done. Well, what if this 33 needed to be modeled as an addition, right? So once we bring it back to this point, keep in mind now, we need to bring everything back to here. So your goal is to think everything has to come back. And that's why I like the timeline, because it keeps it clear in your head. Once you calculated the tax shield, you would have said, yeah, but I'm only in year 4. I do need to bring it back. You would have made this adjustment on the bottom. So now I think I have some room left here. I'm running out of room quickly, aren't I? Let's therefore, the net present value of the entire project is going to be, well, we have negative 38,097. That's from the cash flow. To that, we're going to add 56,657. 56,657.53. That's the tax shield of the 280. To that, we're going to add 4535.32. That's the tax shield of the 33. I think you can see very easily right now that we're going to be net present value positive on this, but let's just have a look and see what happens. Plus our 56,657.53 plus our 4535.32 equals 23,095.85. That's positive. Net present value positive. So this contract should be accepted. How about a debriefing one last time to see what we did? The asset was depreciated to 0, which means the net addition to the pool was 280. So we calculate the tax shield of 280. That's pretty straightforward. We took all of our cash flows and adjusted them for tax, which we did here. These are after-tax cash flows. Since we're selling these assets that are depreciated to 0, this 22.5 is income somehow. We got to call it income, so we adjusted that for tax as well. Simple as that, right? When we took our initial investment, though, it was 280 minus the 15,750. We calculated our tax shield on the 280. We calculated our tax shield on the 33 and brought it back to 0 and just added all three. Came up with a net present value positive. Now, you could have done it easily. You could have just argued, wow, the $33,000 really is just, I'm a small business. I don't want to pay tax. I'm going to model this as an expense. Then you would have adjusted this for the 30% and you would have brought this back to 0, which means that your number here would have not been 21,738. It would have been lower than that because you wouldn't have been discounting 33%. And then you wouldn't have had this second adjustment over here. I think if you would have done it that way, you would have found that you still would have been net present value positive, because look at the size of your tax shield, 56,657. That's pretty big. That's 13.4. I hope I didn't wear you down, but it was the last question to do. So we may as well have done it with a very real world approach and not just a textbook approach. Take you out of the neatness of the textbook and throw you into the messiness of the world, where you do have choices about what you want to call this. Get used to that. As an accountant, you are going to have a choice. You can make the argument that you can call this either a pure expense or an asset, whichever one you want to do. Bravo! We're done our long journey together.